Let's now shift to a view of the broader economy and market with Mish Schneider, Chief Strategist at MarketGauge.com. Mish, thanks so much for being here.
Nice to meet you, Caroline.
Very nice to meet you as well. Not sure if you heard our last guest, but he was pretty bearish on this market. So how are you gauging market sentiment right now? Do you think there's more room to run, or could it potentially be up against a hurdle here?
Well, I don't think it's such an easy answer, and that's why these extreme bearish calls and these extreme bullish calls are something I'm actually trying to avoid, and zooming out, looking at how we started this year, which was basically for a prediction of stagflation. And we're certainly seeing the stagnation part. So the question is going to be twofold. Let's put the debt ceiling aside, because we know that can certainly unnerve the market, particularly if we get any kind of downgrade like we did in 2011. Put the Fed aside and just take a look at what's happening right now. We are actually seeing, after a 2021 huge rally, 2022 huge sell-off, 2023 is kind of stagnating, which means certain areas of the economy may have contracted enough, barring some kind of extra bullet, but that doesn't necessarily mean they're going to grow. And of course, we're seeing all the money going into the growth stocks, because right now people believe that technology is going to be the area that will pull this out. But I'm looking at things a little differently. I'm saying that if we do get a pass on the debt ceiling, for example, and the Fed plays nice and really stays more in a pause level, and unless we have some great geopolitical risk happen, like a war or what have you, which right now it seems like the opposite is happening, Russia, Ukraine starting to get more aggressive, and China, I think, will play nice with Taiwan for now. This is really a situation where all that growth will start to turn into stocks that have been beaten up, because people will say, well, what about the U.S. economy? And I think that's what's really being discounted. Basic materials, for example, have been so beat up. If the debt ceiling gets resolved, doesn't that mean necessarily that the infrastructure will be back on the table and back to some level of growth? And that's what we're seeing now. We're seeing belief that there's going to be no growth and there's going to be no money put into infrastructure, and all of the money being put into these high-fluent tech stocks. And at some point, that rubber band has to burst. So maybe this gentleman will be right and everything goes down, but we'll have to really break down in some of the key areas like retail and transportation and the small caps. Or maybe he's totally wrong and we just get a sort of a knee-jerk reaction and we can break through some of these big resistance areas we've seen based on a 2-year cycle, like, for example, 180 in the Russell 2000, or even 195 or 200. So right now you got to play it like we're in a range and follow things that are in momentum.
Okay, so you mentioned basic materials, but if this rally becomes a bit more broad-based outside of just mega cap tech and AI plays, which other sectors would stand to benefit from a broader-based rally?
Well, right now I think some of the commodities have been beat up because of low demand expectations and also because of recession fears. Like, for example, I think if you're looking at energy and oil, energy has been really one of the underperformers, right, this year. And so it's possible that if we kind of slide through this, that not only would basic materials be something that would be attractive, but also some of the industrial metals and some of the energy names as well, I think could come back into vogue. That's really kind of what we have our eyes on right here.
And then what happens with tech? Is it time to take profits there, or is there still room to run?
Well, I always believe, Caroline, in taking profits. We are not passive investors, right? So the thing, I just want to make 2 points very clear. Number one is any of the names we talk about in the energy or in the basic material space, they offer an incredible low risk right now, which means if we break down under these lows, you got to get out. And it's the same thing when it comes to the tech. If you haven't been taking rounds along the way with these extraordinary gains in NVIDIA, in Meta, in Google, then it behooves you to do so right now and start raising up the stocks. So we actually believe that you have two opportunities. One is to take some money off the table in the high growth stocks and not necessarily buy up here, and two, have a low risk trade in the things that could possibly really move up higher if things don't turn out to be as awful as many fear.
But some of your commentary is if we slide by, if the Fed plays nice, if the economy doesn't, get hit extra hard or take another bullet. So aside from taking those profits, are you comfortable putting money to work right now, or are you waiting for some of these ifs to play out?
Well, so far the ifs have played out, right? I mean, we're at 4,200 or close to it in the SPY. So we've dodged a lot of bullets. The market's been extremely Teflon coated. But to answer your question, yes, I am willing to put some money to work. But again, I am not going to sit there in a major downturn and hope that things turn around. So we have stops. So let's take a stock, for example, like Mosaic, right? Okay, that's a perfect example. It's a fertilizer stock, so it's not necessarily a basic material. But I have heard rumors across the world that there is fertilizer shortage. But let's just take it from a technical standpoint. So Mosaic right now has been hit really, really hard. And it's forming a little bit of a base over the last couple of weeks and holding a significant 200-week moving average, and that's a pretty good one institutions watch. We bought it on the basis of that trading range. But if it breaks down under that 200-week and under the recent consolidation, we're gone. And I think that's how people are starting to think more and more in the retail space, which is really good, because that means you actually have a chance of having small losses, and if you're right, huge gains. And that's ultimately going to be the name of the game in a stagnating economy and a range that could last for a couple more years at least.
All right, so Mosaic down about 17% year to date. It's off almost 45% from its all-time highs. So definitely looking for value there. Any other particular names that you think are values right now?
Well, like Cleveland Cliffs Mines would be another one that we bought. It looked like it bottomed out. It's already gone through its earnings report. It wasn't even that bad. But it's a basic material, which is still out of fashion. But on the other hand, you'll know right away if it cannot hold, let's say, above 1440, which has really been sort of the recent low, you're gone. But if you can get a move up, again, just like we talked about with NVIDIA and Meta, take some profits along the way, but keep a core position in that, because it could mean that we've, again, dodged these bullets of these ifs, as you mentioned, Caroline.
All right, we have to leave it there, but appreciate those picks. And down Mish Schneider of MarketGauge.com.